Welcome to the Pro Ticker Deep Dive.
Thanks for having me. It is good to be here, even if the circumstances are a bit turbulent right now.
Turbulent. I mean, that is the understatement of the year. I really want to start by just, addressing the elephant in the room, or rather the bear in the room.
Yeah, the bear is definitely roaring today.
Right. I want you to picture the scene this morning. You wake up, you grab your coffee, you tap that little app on your phone to check your portfolio, and red. Just a total sea of red.
It is brutal out there.
And not the, oh, it's a healthy correction kind of red. We are talking sell the second car, cancel the summer vacation kind of red. It feels personal, doesn't it?
It does. It always does when the velocity is this high.
Yeah, I was looking at the charts before we started recording, and honestly, if you have been living under a rock or maybe just blissfully offline for the last few weeks, you might be the only happy person left. Today is February 25, 2026, and the vibes are just atrocious.
They certainly are. I mean, if we look at the core sentiment indicators, the fear and greed index is currently toggling between 5 and 8.
Out of 100.
Out of 100, yeah. That is officially classified as extreme fear.
Wow.
It is the kind of reading you usually only see during massive capitulation events, the absolute bottom of the barrel panic.
And looking at the price action, I guess it makes sense. Bitcoin is hovering right now in that $63,000 to $68,000 range. Now, if you rewind the clock 2 years, $68,000 sounded like an absolute dream.
Exactly. But context is literally everything in this market.
Right. We are coming down from that massive euphoria of October 2025, where we hit the all-time high of, what, over $126,000? That is a 50% haircut in roughly 4 months.
It's a classic 50% drawdown, which historically is normal. But the speed of it, the sheer aggression of the selling, is what has rattled people so badly.
It's the whiplash. And this is really what I want to spend our time on today, because I'm reading the listener emails and seeing the comments on the forums, and the overwhelming emotion out there isn't just anger. It's confusion.
Total confusion.
Right.
And I get it.
Because on paper, we had the royal flush, didn't we? I mean, we had the spot ETFs approved and trading with billions of dollars flowing in.
Right.
We have a president in the White House who explicitly campaigned on making America the crypto capital. We had the halving back in 2024. This was supposed to be the super cycle.
The cycle to end all cycles.
Exactly.
Yeah,
This was supposed to be the year we all bought islands. Instead, the market is just bleeding out. Why? What is actually happening?
That is the trillion-dollar question. And it is very easy to just look at the red candles, panic, and sell the bottom. But our mission today is to do what we always do here. Unpack the actual machinery beneath the price action.
Look under the hood.
Exactly, because what we are seeing isn't just some random crash. It is a perfect storm. It's three very specific, very colliding forces.
Okay, lay them out for us.
First, a series of macroeconomic shockwaves. Second, a fundamental structural change in how institutions are trading this asset. And third, a massive technological pivot in the mining sector that almost nobody saw coming.
A perfect storm. That kind of implies that if we understand the weather patterns, we might actually be able to navigate it.
Precisely. While the price action looks like an unmitigated disaster, if you look at the internal plumbing, what the miners are doing with AI, what's happening with government security, and who is actually hitting the sell button, it tells a story of an industry that is transforming.
Growing up?
Yes, it's growing up. And as we know, growing pains are often the most painful pains there are.
Okay, well, let's fly directly into the hurricane then. I want to start with the macro picture. How did we get here? Because this didn't just start this morning.
No, it didn't. To really understand the psychology of February 2026, you actually have to look backwards to October 10th, 2025.
The absolute peak.
The peak and the turning point. Up until that specific day, the market was in an absolute frenzy. Bitcoin had just tagged that $126,100 level. Retail traders were piling in. Leverage was completely through the roof. But on October 10th, the music just stopped.
What happened?
We saw a record-breaking liquidation event.
When you say record-breaking, how big are we talking? Give us the numbers.
Over $19 billion in leveraged positions were wiped out in a single trading session.
$19 billion. That is, that's the GDP of a small nation just vaporizing in 24 hours.
Exactly. And that single event completely broke the market structure. It shattered the confidence of the retail trader. It halted the momentum toward those higher targets people were calling for, $150K, $200. And it initiated this slide.
But that was just the spark, right?
Right. That was the spark. The real fuel for the fire came much more recently with the macroeconomic policy shifts.
Okay, we have to talk about the Trump tariff. Because it feels like this was the moment the floor really fell out just recently.
It was a major, major catalyst. On February 23, 2026, literally just a couple of days ago, President Trump implemented a 15% global tariff on imports.
And the crypto market reacted poorly.
To say the very least, over $100 billion in crypto market value vanished in a matter of hours following that exact announcement.
No, wait a minute. I have to stop you there because this doesn't add up to me.
How so?
The whole sales pitch for Bitcoin, the reason half the people listening bought in the first place is that it is an uncorrelated asset. It is supposed to be digital gold, the lifeboat.
Right, the safe haven narrative.
Yeah. When the government screws up the economy with trade wars or tariffs, Bitcoin is supposed to go up. Why is it acting like a volatile tech stock? Why does a trade tariff tank the lifeboat?
That is the sales pitch, yes. But the reality of market structure is very different. In the current financial era, Bitcoin acts less like gold and more like a liquidity thermometer.
A liquidity thermometer. Okay, explain that.
Think about what a tariff actually does. When you impose a 15% global tariff, you are effectively making global trade more expensive. You are raising input costs for basically every business in America.
Right, things get pricier.
Exactly. You are tightening financial conditions. When trade gets expensive, liquidity, the easy money flowing around the financial system dries up, investors get scared, they retreat to cash, and when liquidity dries up, what gets sold first?
The things that are easiest to sell.
You nailed it. Real estate takes months to sell. Stocks only trade 9 to 4, Monday through Friday. Crypto is the only major market that is open 247, 365 days a year. It is the most liquid asset class on Earth.
So it is the first place investors go to raise cash when they're scared.
Yes. So when the tariff news hit, Bitcoin acted as that thermometer, instantly registering the massive drop in global liquidity expectations.
So it's not necessarily a judgment on Bitcoin's core technology or its long-term value. It's just that Bitcoin is the easiest ATM to access when the building catches fire.
Precisely. You hit the ATM on the way out the door. And that fire, by the way, is being actively fanned by the Federal Reserve.
Ah, the hawkish pause.
Yes. Back in 2025, we had rate cuts. Everyone loved the rate cuts. Money was getting cheaper, assets were flying. But in January 2026, the Fed paused. They were holding rates at 3.50% to 3.75%.
Which doesn't sound that high compared to the 5% days of 2023, but it's definitely not zero.
It's not zero. And more importantly, the expectation has completely shifted. The market hates uncertainty more than bad news.
That's always true.
With the nomination of Kevin Warsh as the next Fed chair, who is notoriously known as a hawk, someone who hates inflation and loves sound, tight money, the market is now aggressively pricing in higher for longer rates.
And this brings us back to basic math. If I can get 4% or 5% on a much safer asset because rates are up, I'm way less incentivized to hold a volatile asset like Bitcoin that doesn't pay any yield at all.
That is the gravity of finance. High rates strengthen the dollar, and they make non-yielding assets significantly less attractive.
So I have to ask the question that I think everyone is screaming at their phone or their car radio right now. Is this just standard crypto volatility? We're used to 20% drops. We all have iron stomachs by now. Is this just another Tuesday in the crypto casino?
The data strongly suggests this is something different, something structural.
Really? How so?
If you look at the crash on February 5, 2026, where we saw a 14% drop in a single day statistically, that was a tail event.
A tail event.
A significant outlier. The velocity of that crash had a z-score of negative 6.05.
Okay, you're going to have to translate that for me. I know z-score sounds super impressive at a fancy dinner party, but what does negative 6.05 actually mean in plain English?
Do you remember learning about the bell curve in high school math? The normal distribution.
Vaguely. The fat middle is where everything normally happens, and the thin edges are the really rare stuff.
Right. A standard deviation, or z-score, of 1 or 2 is a normal bad day in the market. A z-score of 3 is a once-in-a-year kind of storm. The collapse of FTX, that whole disaster, that was about a 4.
And this crash was a 6.
Negative 6.05.
Whoa. So statistically, the speed of this crash was more severe than the FTX collapse.
Correct. In terms of the raw speed and statistical severity of the price drop, yes. It indicates deep structural stress, not just standard market noise.
That's terrifying.
It tells us that the hidden leverage in the system was much higher, and the exit doors were much, much smaller than anyone realized.
That is a very sobering comparison. FTX was an absolute catastrophe. If the math says this crash was sharper than that, okay. That completely explains the macro hurricane.
Yeah.
But you mentioned a second factor earlier, the institutional exodus.
Yes. This is where the story gets really, really interesting.
This is the part that really stings, I think. Because all of 2024 and 2025, the overriding narrative was the institutions are here. BlackRock is here. Fidelity is here. Number go up. We were told that the suits were finally going to save us.
And they were here, but now they're leaving. Or at least a very specific type of institution is leaving.
Let's look at the receipts then. What are the actual numbers saying?
The numbers are stark. U.S. spot Bitcoin ETFs have seen 5 consecutive weeks of heavy outflows.
5 weeks straight.
Year to date in 2026, that is about $4.5 billion leaving the ecosystem.
4.5 billion out, just draining away.
And total assets under management AUM in these ETFs is down about 30.5% since the very start of the year.
That is nearly a third of the pot just gone in 2 months. So the question is really simple. Did they lose faith? Did Larry Fink wake up and decide he hates Bitcoin? Did the whole narrative just break?
No. And this is the most critical thing for anyone listening to understand about this crash. It wasn't a loss of faith in the asset. It was the death of a trade.
The basis trade.
Correct.
Okay, I want you to walk me through this like I'm a 5-year-old with a lemonade stand. What exactly is the basis trade and why did it kill the rally?
So imagine you are a hedge fund manager. You do not care about the philosophy of Bitcoin. You don't care about decentralization or banking the unbanked. You just want yield.
You just want to make a profit.
Exactly. For the last 2 years, there was a massive gap between the price of spot Bitcoin, the actual underlying coin, and the price of Bitcoin futures.
Okay, so the futures were more expensive.
Significantly more expensive. Let's use some simple numbers. Say Bitcoin is currently trading at $50,000. But because everyone in the market is so incredibly bullish, the futures contract, which is a promise to buy Bitcoin 3 months from now, is trading at $55,000.
That is a $5,000 premium.
Exactly.
Okay, so people are paying extra just to lock in the price later because they think it's going much higher.
Exactly. So you, the smart hedge fund manager, you do 2 things at the exact same second. You buy the spot ETF for $50,000, and simultaneously, you sell or short the future for $55,000.
Wait, so you own the asset, but you also bet against it at the same time?
Correct. You are entirely market neutral.
How does that make money?
If Bitcoin goes to $1 million, you make a ton of money on the spot ETF, and you lose an equal amount on the future. If it goes to 0, you lose on the spot and make it all back on the future. But that $5,000 gap, that spread, you pocket that no matter what happens to the price of Bitcoin.
Wow, it's practically risk-free money.
Exactly. So all those billions flowing into the ETFs over the last year, that wasn't necessarily people believing in the long-term future of Bitcoin. That was highly sophisticated hedge funds buying the ETF just to hedge it against a future to collect a risk-free yield.
A significant portion of it was just that.
Yes. These hedge funds, the fast money, were just using the ETF as a vehicle for arbitrage. But here's the massive problem. As more and more people did this trade, the gap closed. The spread tightened.
Because the market gets efficient.
Right. By February 2026, the annualized return on this specific trade compressed to about 4%.
Just 4%.
And remember what we just said about the Federal Reserve?
Rates are at 3.5% to 3.75%.
That's exactly. If I am a fund manager and I can get nearly 4% in risk-free treasury bonds backed by the full faith and credit of the U.S. government, why on earth would I deal with the operational risk, the exchange risk, the custody risk, and the wild volatility of Bitcoin for the exact same 4% return?
You wouldn't. It's a complete no-brainer. You take your money out of crypto and you go home to treasuries.
And that is exactly what they did. We saw massive hedge funds like Brevan Howard reduce their Bitcoin ETF exposure by 86% in Q4 2025 alone. Think about that volume.
So they didn't sell because they suddenly hate crypto. They sold because the arbitrage opportunity just evaporated.
That is exactly right.
That is fascinating. It's like they were tourists.
That is the perfect analogy.
They came for the nice weather, the easy yields. But the moment the weather turned, the moment the yield dried up and the Fed paused, they just packed their bags and left.
Yes.
Meanwhile, the locals, the long-term holders, the people who actually believe in the asset and dollar cost averaged in, are the ones stuck standing out in the rainstorm.
And the locals are hurting badly right now. Currently, roughly 45% of the circulating Bitcoin supply, that's nearly 9 million individual coins, is officially underwater.
Held at a loss.
Held at a loss. And this creates what we call a supply overhang in the market.
What does that mean for the price?
Every time the price tries to rally a little bit, every time we see a green candle, you have people who bought at 70K or 80K looking at their portfolios and thinking, thank God I can finally get out at break even. So they sell.
It creates a ceiling.
A massive ceiling that is very, very hard to break through without overwhelming new demand.
Man. So we have a macro hurricane, and we have the tourists fleeing the scene because the basis trade is dead.
Correct.
But you mentioned a third factor at the very beginning, and this one seems, well, it seems weirdly contradictory. When I was looking at your notes earlier, I honestly thought it was a typo.
You're talking about the mining metamorphosis.
Right, because usually when the price goes down, mining difficulty goes down. Right? Miners start turning off their machines because they aren't making money. It gets easier to find a block.
That is the historical pattern, yes. But that pattern has completely broken in 2026.
So what are we actually seeing?
On February 19th, 2026, Bitcoin mining difficulty hit an all-time high. It jumped 14.7% in a single adjustment period.
Wait, I really need you to confirm this. The price is crashing. It's down 50% from the high, but it is 15% harder to mine a coin.
Correct.
That sounds like a business nightmare. If I ran a factory and the market price of my product dropped 50%, but my internal cost to produce it suddenly went up 15%, I'd be bankrupt in a week.
It is exactly that. We call it the profitability paradox. Think about the massive squeeze here. The fiat price of the asset you produce has been cut in half, but the difficulty, which roughly correlates directly to your electricity cost per coin, just went up 14%.
So your revenue is halved and your operational costs are up.
Exactly. There is a specific metric called hash price. It basically measures how much a miner earns for their raw computing power.
Where is it at?
It is currently sitting under $30 per petahash per day. That is historically devastatingly low. It is essentially the absolute death zone for inefficient miners.
So why aren't they turning the machines off? Why is the difficulty going up instead of down?
Yeah, because the industry is aggressively pivoting. They aren't just Bitcoin miners anymore. They are becoming massive energy arbitrageurs and AI infrastructure plays.
The pivot to AI. We've seen the headlines, right? Cipher mining, rebranding as Cipher Digital, Bitfarms expanding.
Exactly. Bitfarms, Bitdeer, Cipher, they're all doing it. They realize something crucial. They have two things that are more valuable than gold right now.
Which are?
Massive, heavily negotiated power contracts and ready-to-go data center infrastructure.
And the AI companies, the OpenAIs, the Googles, the Anthropics, they are hungry for power.
They are starving for it. So the miners are retrofitting their massive warehouses. They are ripping out the Bitcoin mining rigs, the ASICs, which can only do one thing, hash SHA-256, and they're putting in high-performance GPUs for AI computation.
But wait, if they were switching the racks over to AI, why is the Bitcoin mining difficulty going up? Shouldn't that mean there is less mining happening?
It's a great question. The difficulty spike is likely coming from the brand new generation of mining rigs, the S21s, and newer hyper-efficient models being plugged in by the giant corporate miners who can afford them, while all the older, less efficient machines get retired. It's an all-out efficiency war. But here is the real kicker for the Bitcoin price, and this is why we are talking about it today.
Okay.
To fund this massive pivot to AI, to buy thousands of those incredibly expensive NVIDIA chips and retrofit the cooling systems, what do the miners have to do?
Well, they need cash. You can't exactly buy a bulk order of NVIDIA chips with Bitcoin directly, usually.
Yeah.
You need US dollars.
And where's all their cash stored?
In their corporate Bitcoin treasuries.
Exactly. They are selling the family silver to build the new factory. Bitcoin miners are currently becoming massive, sustained Bitcoin sellers on the open market just to fund their transition into AI data centers.
Wow, so the mining industry isn't dying, it's evolving. But that evolution requires them to dump their massive Bitcoin holdings onto the market right now.
Exactly. It's a short-term, massive wave of sell pressure for a long-term corporate survival strategy.
So if someone asks, is the mining industry dying? The answer is no. But is it actively hurting the Bitcoin price right now? The answer is yes.
Precisely. It is a completely necessary pain for their future, but a huge drag on our present market.
Okay, so let me get this straight. We have the miners dumping their corporate treasuries to buy NVIDIA chips. We have the hedge funds dumping their ETFs because the arbitrage yields dried up.
Yeah.
In a market like this, you usually look for a buyer of last resort.
The White Knight.
Right, and back in 2025, we were promised the biggest buyer of all, Uncle Sam, the Strategic Bitcoin Reserve.
Ah, yes. Good old Executive Order 14233.
I remember the headline so vividly. President Trump signs the paper. The quote was something like, "We are going to buy 1 million Bitcoin." The U.S. will be the crypto capital of the planet. It was going to be the Fort Knox of the 21st century.
March 2025. That was definitely the high water mark for government enthusiasm.
So it's been almost a year. Where is the reserve? Are they buying the dip to save us?
Stalled. It is completely stalled.
Why? I mean, the president signed the executive order. Usually when the president signs something, things happen.
This is where political reality meets bureaucratic inertia. And honestly, the details here are, well, they're genuinely shocking. If you think the DMV is bad, wait until you hear how the U.S. government manages its crypto.
Oh, boy. Lay it on us.
So, the Department of Justice Inspector General recently did a massive audit of how the government handles its existing crypto. Because remember, the reserve was supposed to be initially seeded with seized assets, Bitcoin taken from criminals, from the Silk Road bust, from hackers.
Right. We already have the coins sitting there. We just need to move them to a shiny new reserve wallet.
The audit found that the U.S. Marshals Service is currently tracking $22 billion in government crypto assets using manual Excel spreadsheets.
You have to be joking.
I sincerely wish I were.
$22 billion. That is the wealth of a small nation. And they're tracking it like I track my monthly grocery budget. Column A, Bitcoin. Column B, estimated value.
Manual spreadsheets. And the consequences are terribly real. The audit explicitly noted deficient security procedures. And there are very credible allegations from on-chain sleuths, like ZachXBT, that $40 million in government crypto was actually stolen in 2025 directly because of these lax security measures.
Wait, they got hacked. The foundational assets of the strategic reserve got hacked.
The assets destined for the reserve were compromised, yes. It's a spectacularly bad look. And it really explains why the White House Crypto Council Director Patrick Witt is suddenly talking about obscure legal provisions holding things up.
Obscure legal provisions sounds exactly like government code for we don't actually know who has the private keys.
It's also a massive interagency turf war. The Justice Department has the coins, the Treasury wants the coins for the reserve, but legally transferring them is an absolute nightmare. And then there is the budget-neutral problem.
What's that?
The current administration can't just print new money to buy Bitcoin on the open market without adding to the national deficit. They are politically bound to do it in a budget-neutral way. At one point, there was a serious proposal floated to sell off some of the physical U.S. gold reserves to buy Bitcoin.
Oh man, I bet the traditional gold bugs love that idea.
Politically, it is a complete non-starter. I mean, you can just imagine the Senate hearing. We are going to sell the physical gold bars at Fort Knox to buy magic internet money that just crashed 50%.
Yeah, that's not passing. Not with these charts.
Exactly. So the strategic reserve is currently just a nice piece of paper and a very messy spreadsheet. It is absolutely not the institutional buying pressure we were promised.
However, while the feds are fumbling with Excel, the states seem to be moving.
That is the one bright spot here. Texas and Arizona have officially passed state-level reserve laws. They are moving forward with their own treasuries. It's adoption, but it's highly uneven. It's certainly not the U.S. government buying billions every week that the market fully priced in back in 2025.
So another massive bullish narrative, the U.S. Reserve is effectively on ice. Let's talk about the other thing keeping people up at night, security. We just talked about the marshals getting hacked, but the private sector isn't doing much better, is it?
No, not at all. 2025 was a record year for crypto theft in terms of total value. $3.4 billion stolen.
And the big one was Bybit.
Correct. The Bybit hack in February 2025, $1.5 billion lost in a single devastating attack.
$1.5 billion. Who even does that? That's not a teenager in a basement guessing passwords. That's state-level actor stuff.
It is the Lazarus Group, North Korea.
It's always Lazarus.
It is. But their tactics have fundamentally changed, and this is terrifying for the industry. We are seeing a major shift. They are doing fewer hacks overall, but they're targeting much, much larger pots of money. The ratio of the largest hack to the median hack has actually crossed 1,000x.
Wow.
They're hunting whales, not minnows. They are spending months quietly penetrating a single massive exchange just to drain the whole thing at once.
And what did they even do with $1.5 billion?
Yeah.
You can't just deposit that into a bank account. You can't just walk into a Wells Fargo with a thumb drive of stolen Bitcoin.
This is where we get into the Chinese laundromat.
That sounds like a spy novel title.
It operates exactly like one. The intelligence sources describe a highly sophisticated shadow economy. They use a specific stablecoin called A7A5, which is pegged to the Russian ruble running on the Tron network.
Hold on. A ruble-pegged stablecoin on the Tron network. That is the most cyberpunk dystopia sentence I have ever heard in my life.
It really is. They use this decentralized network to settle massive payments with hardware suppliers. Basically, North Korea steals the crypto, converts it entirely to this obscure stablecoin, and sends it to Chinese logistics and electronics firms to buy physical goods. It effectively launders the stolen money through a mesh of real-world commerce.
So let me get this straight. We have North Korean hackers stealing billions, laundering it through Russian-pegged coins to Chinese hardware suppliers. It's a global shadow banking system that completely bypasses U.S. sanctions.
Exactly, and the broader market knows this is happening. It heavily contributes to the ambient fear. It makes traditional institutional investors very nervous about custody risks. But honestly, there is an even bigger fear looming, one that attacks the foundational technology of Bitcoin itself.
The quantum fear.
Yes.
I've been seeing this in the headlines everywhere lately. Quantum computers will break Bitcoin. And interestingly, looking at the charts, physical gold is up 55%, while Bitcoin is lagging badly. Is this why? Is there a literal flight from breakable digital gold to unbreakable physical gold?
It is becoming a very significant factor. Institutional investors are deeply worried that quantum computers, specifically using something called Shor's algorithm, could eventually crack the core encryption that secures the Bitcoin network.
Break that down for us. What is Shor's algorithm?
Without getting too bogged down in the math, Bitcoin uses a cryptographic scheme called Elliptic Curve Digital Signature Algorithm, ECDSA. It relies on the mathematical fact that it is very easy for a normal computer to multiply two huge numbers together, but it's almost practically impossible to take the final result and figure out what the two original numbers were.
Right, it's a one-way street.
Exactly. That one-way math is what keeps your private key safe from anyone looking at your public address.
Okay.
Shor's algorithm is a theoretical way for a quantum computer to do that reverse math incredibly fast. If a quantum computer gets powerful enough, it could theoretically derive your secret private key just from looking at your public address on the blockchain.
Right.
If that happens, the game is totally over. They can spend your coins.
That sounds catastrophic. Is that a real imminent threat right now?
Yeah.
Or is this Y2K all over again?
It is much more like Y2K. It is a legitimate, serious engineering challenge, but it is not an immediate doomsday scenario. The mainstream headlines are scary, but the core developers and engineers are already fixing it.
How can you actually patch Bitcoin against a quantum computer?
Yes, you can. There is a major upgrade proposal called BIP 360. It's a quantum-resistant protocol. It basically uses a completely different type of cryptography that even a massive quantum computer struggles to solve, and it is already being rigorously tested on Bitcoin testnets.
So just like Y2K, the engineers are quietly patching the code in the background while the media screams fire in a crowded theater.
Exactly. Michael Saylor actually recently dismissed the whole quantum fear as just noise, noting that the real threat is likely a decade away and the protocol code will easily evolve before it gets there. But, as we discussed, markets absolutely hate uncertainty. And the headline, "Quantum Computer Breaks Bitcoin," is a very powerful uncertainty narrative. It creates a massive psychological drag on the price.
Right. So let's just recap for a second. We have a macro hurricane with tariffs and sticky interest rates.
Yeah.
We have an institutional exodus as the risk-free basis trade dies. We have miners dumping coins to pivot their warehouses to AI. We have a paralyzed government reserve stuck in Excel hell. And we have quantum fear. It's a lot. It's a very heavy list.
It is a heavy list. It's a perfect storm.
So let's pivot ourselves. Let's look at the outlook for the rest of 2026. Where do we go from here? Is this crypto winter going to last forever?
No winter lasts forever, but we need to be highly realistic about the timeline here. We are currently in a phase that I would call repair mode.
Repair mode. That implies things are fundamentally broken and need fixing.
The market structure needs fixing. We need time to flesh out all the hidden leverage. We need the tourist money, the hedge fund basis traders to finish their exiting process. We need the miners to finish their expensive AI pivot and stop dumping their treasuries. This isn't a magical overnight fix. This repair mode likely lasts until at least summer 2026.
Summer. So we've got a few more months of brutal chop.
Likely sideways chop, yes, and potentially testing even lower support levels.
How much lower? Because I don't know if my heart or my portfolio can take much more.
Well, we have a dry powder problem right now. Stablecoin inflows, which is the USDT and USDC sitting on exchanges ready to buy the dip, have basically dried up. We are actually seeing net outflows of stablecoins. Without that fresh new money entering the system, it's very hard to get a sudden V-shaped recovery.
So no moonshot next week.
Highly unlikely. However, there is a floor.
Please give us the good news. Where is the floor?
While the hedge funds are busy selling, the conviction whales, these are non-exchange wallets, the true believers, the entities who hold for years, have actually bought 270,000 Bitcoin in just the last 30 days.
270,000 BTC. That is massive accumulation.
It is huge. They're silently absorbing the selling pressure. And if we look at specific valuation models, specifically CVDD,
Buzz, you mentioned CVD in the notes. It sounds like a boring government agency. What is it?
it stands for Cumulative Value Days Destroyed. It sounds incredibly complex, but think of it simply as a measure of old hands selling. When a Bitcoin that hasn't moved in 10 years suddenly moves on chain, it destroys coin days. It signals that a long-term holder has finally capitulated and lost faith.
So if that metric is high, the OGs are selling.
Exactly. And right now, the price strictly associated with the CVDD floor is around $80,000.
Wait, we are way below that right now.
We are. Historically, whenever Bitcoin trades below its CVDD floor, it marks a generational buying opportunity. It essentially suggests the asset is fundamentally undervalued relative to the deep conviction of its long-term holders.
Undervalued. That is a word I haven't heard in a while.
But in the extreme short term, pure panic, the wick down, could take us down to test $55,000 or even $60,000. That is the realized price level, the average price literally everyone paid for their coins. That is usually the ultimate unbreakable line in the sand.
So 55K to 60K might be the absolute max pain point.
It's very possible.
Okay, so for the listener trying to navigate the next few months, what are the actual catalysts we're watching for?
Three main things. One, the Fed. We need to see inflation data cool down so they can end this hawkish pause and maybe signal rate cuts again.
Makes sense.
Two, the Trump tariffs. If those get walked back or stabilized in negotiations, global liquidity might loosen up again. And three, the quantum narrative. If the BIP 360 upgrades get implemented smoothly on the mainnet, that specific fear will completely evaporate.
And the miners.
Watch the miners closely. When they stop selling, when their AI pivots finish and start generating massive fiat revenue, that sell pressure just turns off. And suddenly you have a mining industry that is wildly profitable again, but powered by AI money, not just Bitcoin block rewards.
Which really brings us to the big picture here. Let's synthesize this whole deep dive.
The crash of 2026 feels absolutely terrible in the moment. But when you zoom out, it is actually a story of market maturation. Think about what we are shedding right now. We are shedding the arbitrage traders who didn't care about the asset. We are forcing the miners to become hyper-efficient, diversified energy companies. We are forcing the government to admit its security is terrible and hopefully upgrade it from spreadsheets to vaults.
It's growing pains. Violent, expensive growing pains.
Exactly. The market is shedding its adolescence. It's officially moving from a speculative retail casino to a hardened piece of global financial infrastructure.
And that leads me to a final thought, something for everyone to chew on before we go.
Yeah.
We spent a lot of time today talking about miners pivoting to AI, selling their Bitcoin to buy AI chips.
Yes, a major driver of the current price action.
But think about where that actually leads. If these mining companies become the physical backbone of the global AI infrastructure, and those AI agents start generating massive wealth on their own,
I see exactly where you are going with this.
what currency will an autonomous AI use? It won't have a bank account at Chase. It won't use a Visa credit card. It needs programmable instant money.
It will use digital permissionless rails.
Exactly. So right now, the miners are selling Bitcoin to build the AI. But in 2027, the AI itself might just be the biggest buyer of the Bitcoin mined by the very infrastructure it now occupies.
The system's merging into one infinite economic loop. That is a genuinely fascinating thought.
It's a wild world out there. Stay curious, stay informed, and maybe check your own security settings while you're at it to make sure you aren't using an Excel spreadsheet.
Absolutely. Good advice.
Thanks for listening to the Pro Ticker Deep Dive. We'll catch you on the next one.